going to talk about Chapter 15. Chapter 15 is easier for most people because we're going to talk about money, and we all have a basic understanding of money. Finance is the study of how money is managed by both companies and the government. So as we move along, you'll know a lot of this stuff, but I hope you'll learn some new facts as well. So money is a currency. It's anything generally accepted and exchanged for goods and services. So we think of money as bills and coins, but in the business world, when we talk of money, we're talking of credit cards, stock, selling stock, loans. We're talking about checking accounts, all different kinds of ways to trade money. Now, currency itself is dollars and cents. So money, cash versus currency can be two different things. Before fiat money, everybody bartered, and you traded things. I had a bushel of corn, and you had 2 chickens, and we traded them, or you had a load of straw, and I could build a barn, and we traded those. So that was the kind of bartering that went on prior to there being fiat money. The problem with that is it's hard to judge the value of what you're trading, and it can get really complicated when you have multiple people involved. So I have a load of hay, and the next farmer needs his barn built, but he doesn't need any hay, and the last farmer needs 2 cows, or has 2 cows to get rid of, and he needs hay for the rest of his herd of cows. So you have to figure out who trades who and how that money happens. Well, now with a cash system or a medium of exchange, we could say this load of hay is worth $2,000, my work for you is worth $2,000, and the cows are worth $3,000, so whoever trades with him is going to have to give $1,000 to boot. So it becomes easier now that we have fiat money, paper money, coins, and we have an expectation of how much something's going to cost. So, for instance, let's talk about a gallon of milk. Well, we all go to the store and we expect a gallon of milk to cost $4 and something. Or we expect a loaf of bread to be $2.19, the brand that we like. Or we expect a bottle of laundry detergent to be really expensive, like $14. But we know what that expectation is, and we know if we have enough money in our wallet, in our checking account, on our credit card to pay for it. So when we went to a medium of exchange, it made those processes much easier, although bartering is still a great way for people to exchange goods, as long as everyone agrees on the value of what they're bartering. So money has some functions. One is it is a measure of value. So I was just talking to you about that common yardstick. We know how much we think a gallon of milk should cost, or a soda, unless we go to a baseball game and then it's a whole lot more expensive. We know the value of those things. We sort of know what a gallon of gas is going to cost, and when the price of gas goes up or the price of gas goes down, we know that what that means to us in currency. Money is also a way to store value, a way to accumulate money, to accumulate things so that you can save it up and spend it later. The value of your stored money is directly dependent on the health of the economy. So when we talk about the dollar being weak or the dollar being strong across the world, it's based on the health of our U.S. economy. And deflation occurs when prices of goods fall. That hasn't happened in groceries lately. I find groceries really expensive, but deflation is when prices fall. And we have had prices fall in gasoline, so prices have fallen in something. So here are the characteristics of money. It's acceptable. Anywhere you go to buy anything, almost they'll take a dollar bill or a $100 bill. It has to be divisible. Divisible means when you hand someone a $100 bill and your bill was only $70, they can give you $30 back. So there's pennies, nickels, dimes, quarters, dollars, $5, $10, $20, $50, $100, and you can divide it so you can make change with anybody. It has to be portable. Gold was not very portable. So back in the day, when they exchanged in gold, you had small amounts, but if you had larger amounts, it was not easy to carry back and forth. So we have dollars and coins, and debit and credit cards, which are portable. Another characteristic of money is that it's stable. We know what a dollar will buy, not much, but we know what $10 will buy or $20 will buy. And we know if we go into the store with this amount of money and the price tag says $20, we need to give them $20. In an unstable economy, one day an item may be $20 and the next day it may be $50. Those are the kind of things that happen in Venezuela, happened to Russia when it went communist, and then when it went not communist. So we know pretty much what a dollar will or won't buy. Durability, it has to last for a while. You know, a $20 bill is in circulation for a long time, maybe 7 years, maybe longer than that. $100 bill is in circulation probably 20 years. So these dollars the federal government makes are durable, and they'll last a long time and can be passed along to person and person. And it's supposed to be difficult to counterfeit. I don't know a lot about counterfeit money. I've had students who worked at banks, and we've talked about if they'd ever seen a counterfeit bill or not. Most of them had seen a counterfeit bill, but they even had trouble telling the difference, which is the hard part about counterfeiters. We have such great technology now that it's somewhat simple for them to counterfeit money. If you have a counterfeit dollar, it is worthless. So if by some chance you go to a bank and they give you change, you know, you cash a check and they give you $300, and one of those $100 bills is counterfeit, you're stuck with it. It's worthless. So you can go back to the bank and say, you give this to me, you gave this to me, but they probably aren't going to think they gave it to you. I don't know any way around that. Just be careful, look at your money, learn what counterfeiting means. This is, the US government keeps redesigning it to make it more difficult to counterfeit, to stay ahead of counterfeiters and protect people from it. At one point, there was a small thread running through it. That's not on it anymore. Now I see that blue line. This is a pretty current piece, a pretty current $100 bill. There's a texture to the paper. It becomes important that you sort of know what those things are, those indicators of counterfeit currency, so that you can detect it if you happen to end up with one. Okay, so I told you that money is more than just dollars and cents. It is paper money and coins, but it's also a checking account, savings accounts, money market accounts, CDs, and what we call near money. I think that we talk about that in a later slide, but near money is things like a cashier's check, traveler's check, a money order, that you have guaranteed payment. If someone gives you a check, which is near money, or like money, it's a currency, then there's no guarantee on it until you take it to the bank, you present it, and they give you the cash that check is equal for. But cashier's checks, money orders, and traveler's checks are issued by a bank, so they're guaranteed by the bank. So if someone wants to pay you for something and they don't want to give you cash, if they'll give you a cashier's check or a money order issued by a bank, it's honored by that bank. So credit cards. I feel like credit cards are the bane of our society. I feel like credit cards, most of you know, they're a pre-approved line of money granted by a bank or financial company. People use credit cards, they get in credit card debt, and it is a really, really difficult situation for people. Interest can run high, especially if you don't have good credit or if you're just establishing credit. So I use a credit card every day, no question, because I carry cash too, and my husband uses cash almost exclusively. But the thing I do is I pay my credit card off every month so that I don't ever pay any interest in it. The problem with credit card debt is it can snowball on you. You can pay just a little bit next month, and a little bit the next month, and a little bit the next month, and then you're in trouble because you get far behind and you can't catch up on it. And you're paying for stuff that you usually don't even have anymore, because credit card is usually used for clothing purchase or meal purchase or gasoline purchase, and then the problem is that those items are completely gone and you still have the credit card debt. So if I give you one warning in this class and you remember nothing else, I caution you about credit card debt. Also within credit cards are reward cards and debit cards. A reward card is one where you get points for something. I use my credit card and I get travel points, so, but again, I pay it off every month. A debit card is one that looks like a credit card, but you have money in your account to back it up. And that is a much better way to do business if you're having trouble controlling your credit card. And I already talked to you about Near Money, that's guaranteed as cash by the organization that issues it. So the American financial system is controlled by the Federal Reserve Board, the Fed. They're guardians, the guardian of our financial system. They're independent of the federal government. They were established in 1913 to regulate the nation's banking and financial industry, and it's organized into 12 regions. Now, we have a Federal Reserve Bank in Kansas City. They do have tours and they're open. Can't get to the cash, but you can go in and see the cash behind big bulletproof unbreakable glass windows, and they just have carts and carts of cash. If you're ever there and you have a couple hours, it's really kind of an interesting place to visit, because you learn about the history of our money and you learn about what the Federal Reserve Bank actually does. The Federal Reserve Bank is they set the chief economic policy arm of the U.S. They set the culture for our economic policy at the time, and they try to create a positive economic environment by doing these things. Sustain low inflation, high levels of employment, balance in international payments, and long-term economic growth. So they want our inflation. They don't want prices to increase quickly. We don't want unemployment. We want everybody who wants a job to be able to have a job. Balance in international payments. We need as much money coming in from other countries as we have going out. Just like you need more money coming in your paycheck, or as much money coming in your paycheck as you have going out. And then they look at long-term economic growth and how to see these things happen in the future. So the Fed has 4 major functions, and this is how they control the system. They control the money supply with monetary policy. So sometimes banks will raise interest rates, which means the Fed raised interest rates, the money that are loaned to them, they raise interest rates, and then it slows borrowing down, or they lower interest rates and it increases borrowing. The Fed regulates financial institutions. They cause bank regulations. They tell banks how much they have to have on deposit. They tell them what percentage of those deposits they can lend out. They also manage regional and national check clearing procedures. So if you write a check to someone, it takes a couple of days to clear your account. It's because it has to go through the Federal Reserve Bank, and they are in charge of, if you have a complaint about a counterfeit check or about a check that's been forged, it goes back through that clearing process. And they supervise the FDIC insurance, Federal Deposit Insurance of commercial banks in the Federal Reserve System. So, something I just learned recently, and I'm not going to be selling marijuana anytime soon, but I thought this was really interesting. I bought a loft downtown to use as my home when I'm in Springfield, and to use as an Airbnb on weekends. So when I went into the bank, they asked me this whole list of questions about would I be participating in the sale or manufacturing of marijuana. And I was like, no, and why would you be asking me that? Well, if you're a business that deals in marijuana, you cannot bank at a federally insured bank because marijuana is still controlled at the federal level. So I said, well, if I was running a marijuana business, where would I do my banking? And they said, you don't, you just have a great big safe. Now, I do understand that now marijuana shops like Colorado and California now can take credit cards. They use a state bank that is not federally insured. But I also understand that even the legal marijuana shops that are in states where it's legal or where medical marijuana is legal, they still do a lot of cash business that federal banks are still not allowed to do business with them. So I expect to see those laws change in the next few years, because I expect to see marijuana become not controlled federally. But I just thought that was a really unique thing. I never thought about the fact that if you run a business that's not legal nationwide, you can't bank with a bank that's federally insured. Now, the FDIC, well, I'm gonna come back to that later. Monetary policy, it's the mean by which the Fed controls the amount of money available in the economy. And they like to keep supply and demand pretty balanced. If they didn't, it could result in rapid price increases, inflation, or economic recession and a slowdown of price increases, which usually results in unemployment. So we have the Fed to thank for our low unemployment rate right now, a reasonable interest rate, money availability. Back in 2008, I'm gonna wait though, because I have a future slide about that and I'll talk about it. Here's their main policy tools is open market operations, that's buying or selling treasury bills, reserve requirements, which is the percentage of deposits that banking institutions must hold in reserve, the discount rates, the rate at which they loan money to the bank. So what happens is the Federal Reserve Bank has what they call a prime rate, and that's what they loan to banks. And then banks loan that out to other people, and banks, the difference in those interest rates are how banks make some of their money. Also, they have your deposits, your checking, your savings deposits. They pay you 2% on a savings account or CD, and they loan that money to 5%, so that's another way banks make money. If you hear prime rate, that's the rate at which you can borrow money. And if you're a prime borrower, then you usually get, I need to back up a second. Prime is the rate at which the bank can borrow money from the federal government. And then your interest rate is usually prime plus 1 or prime plus 3. If you can get a prime plus 1 interest rate, then you know that your credit is really, really good, because the bank is only making 1% on you. If you're a 9% interest rate, which right now is about prime plus 4, then your credit risk is higher, and therefore the bank charges you more. So this is just a list of tools for regulating the money supply, buy and sell government securities, rate increases, raise the discount rate, lower the discount rate, increase reserve requirements. So in a comfortable economy, a bank may have to have a 20% reserve requirement, that of the money of yours, the hours that they have to have 20% set aside, but they can lend out 80% of it. In an economy where inflation is high and there's a lot more people not able to pay their bills, sometimes the Federal Reserve Bank will tighten down the restrictions, and a bank has to have 30 or 35% of those reserves held back in case of an emergency. They also can, the Fed can relax or restrict credit controls. 2008 is when the bottom fell out of the banking industry, and that's because people were buying houses they couldn't afford. They might have had more of a loan against a house that was more than the value of the house. They had secondary loans, they had all kinds of stuff, and our economy got tight, and people were not able to pay for their houses, which means a lot of people went bankrupt, and a lot of banks repossessed houses, and there were a lot of houses owned by the banks at that point, and the federal government had to tighten policy. Everyone should not own their own home. Some people should rent, some people should live in apartments. But at that point, it was kind of the trend, the culture, that everybody owned their own home. And that really isn't always a good trend. There needs to be a certain amount of money down, there needs to be a certain amount of protection, and a lot of people are willing to get it over their head to have the house they want, and that's just not always a good idea. So commercial banks are the main kind of banks. They're the largest and oldest, and they are a source of funds for loans to businesses and individuals. We also deposit our money there. We have a checking account or a savings account. Savings and loans, it's called a thrift. They primarily have savings accounts and make mortgage loans, although many of them are much like commercial banks now. Credit unions are owned and controlled by the depositors, and they're usually where a group of people put their money together, like employees or a religion or a profession. That's a different kind of bank, and it's actually owned by the members. And a mutual savings bank is similar to savings and loan. They're owned by the depositors, but they really are in the East Coast, not really across the U.S. So the FDIC, the Federal Deposit Insurance Corporation, is that insurance that banks have and the federal government provides, the feds provide, and it insures individual bank accounts. The FDIC was established in 1933, and that was after the Great Crash and the Great Depression had started, and people were distrustful of banks, and so the FDIC was created in order to make people more trustful of banks. This insures each person $250,000 at the bank. So if it's a joint account between my husband and I, and I'm insured for $250,000 and he's insured for $250,000, as a couple you can be insured for $500,000, which means if that bank goes under, then $500,000 of our money will be covered by the federal government. The National Credit Union Association is the same type of organization, but it regulates and insures credit unions. So 2008 was a really awful year for many people. A lot of people lost their homes. It was a huge recession. 52 bank failures between 2000 and 52 bank failures from 2000 to 2008. Beginning in 2009 until 2014, 474 banks failed. So had there not been FDIC in place, a lot of people would have lost their money. A lot of people still lost their homes because banks had let people overborrow from their homes. The banks then failed, and it was a serious time in our economic past. I feel like we're just now recovering from it. And as of March 2014, the number of problem banks has declined for 12 quarters in a row. So the federal government bailed out a lot of banks. They bailed out a lot of individuals, but it seems that it is over and that banks are healthier, and that the government, the Fed, including the FDIC and the federal government, has put in some real restrictions on banks on what they can and can't do. So we talk about cyber currency. I think the main one we all know about is Bitcoin. And do I think cyber currency, students ask me this every semester I teach this class seated. Oh, do you think cyber currency is the thing of the future? Well, I think we're already using cyber currency. I think with EFTs, ATMs, all the different kind of credit cards and payments online and all this stuff, I think we're already to a place of cyber currency. I feel like cryptocurrency is something else. I think we may stay with the American dollar. The Bitcoin is not stable. If any of you want to do research on Bitcoin, I only know enough about it to be dangerous. I know the value was placed on it by how much somebody was willing to deliver 2 pizzas in exchange for so much Bitcoin, and it's just gone crazy there. The US dollar at one point had a silver standard, and it was backed by so much silver and gold that the US government owned. That is not true anymore, but the US dollar is backed by the good faith of the American government. How do I feel about that? Well, I feel like the good faith of the American government is a better insurance on my money than some guy in Texas or in Florida who sold 2 pizzas for some Bitcoin, and that's how he established the value of it. So I think there's a chance we may go to a cryptocurrency someday. I don't think it's gonna be Bitcoin. And Bitcoin, according to the way it was set up, is obsolete in the 2040s anyway. But I think we're also already at a cyber currency level. Cryptocurrency, I'm not so sure about at this point. But at one point, we didn't believe debit cards would be popular anyway. And when I was younger, McDonald's didn't take a debit or credit card, so it didn't matter. Anyway, we also have automatic clearinghouses, where you can just pay things online. Deposits and withdrawals can be made online banking. So I think the world's moving pretty fast, and if we're not keeping up with it, we're way behind. So that's my fast conversation on money. I hope you all are having a good week, and good luck on chapter 15.